Opening an IRA has long been an effective strategy for investors to reduce their tax liability. This type of investment account offers powerful tax advantages. Holders can either defer taxes at the time of contribution or enjoy tax-free distributions. With a self-directed IRA or SDIRA, you can combine the tax advantages of an IRA with the flexibility to invest in alternative assets like real estate, promissory notes, or precious metals. Every year, many SDIRA holders come to us seeking clarification on how exactly these investment accounts are taxed. So, let's dive in. The first thing to understand is that in the eyes of the IRS, an SDIRA is exactly the same as any other IRA from a bank or a brokerage. Really, the only difference is that with another IRA, their investment options are limited to publicly traded securities where valuations are set by the market. With an SDIRA, you're able to hold assets that are bought and sold in the private markets. This makes their valuations a bit more opaque and difficult to determine. So while an SDIRA holder doesn't have to file an annual tax return just on behalf of their SDIRA, they do have to provide an annual fair market valuation of the assets held in their accounts. Another difference with SDIRAs is that even a tax-deferred account may still owe taxes for the year. Now, there are two reasons why this might be the case. One is that one of the assets in your SDIRA participates in regular unrelated business activities and takes in unrelated business taxable income, otherwise known as UBTI. And another is if your SDIRA has a real estate asset that was leveraged with a non-recourse loan. Some of this income would then be classified as unrelated debt financed income, or UDFI. In each of these cases, your SDIRA would likely owe UBIT, Unrelated Business Income Tax, for the year. And this would have to be filed on IRS Form 990T. Another common question we get about SDIRA taxation is whether you need an employer identification number. Now, most SDIRA holders don't need to apply for their own EIN. There are really only two cases why your SDIRA might need its own employer identification number, or EIN. One is if your SDIRA owes Unrelated Business Income Tax, or UBIT, for the year. Number two is if your SDIRA is part of a multi-member LLC. In either of these cases, your SDIRA should acquire its own employer identification number. Finally, we'll finish off with 4 strategies that SDIRA holders might use in order to reduce their tax liability. Number 1, starting off with the simplest, maximize contributions to lower your tax bills over time. Just as the earnings from a high-performing investment can compound over time, so too do tax advantages. You really don't want to miss out on any single year where you're able to contribute more to your tax-preferred accounts, whether that's a traditional IRA, Roth IRA, SEP or Simple, 401k. You really want to take advantage of all of your accounts during the year to minimize your tax liability. Number 2, consider Roth IRAs. So you probably heard about Roth IRAs and how they really can compound over time, but they have the exact same contribution limits as a traditional IRA. So you might be wondering, how exactly do Roth IRAs present an advantage over traditional IRA? Well, the key difference is that Roth IRAs are made up with post-tax contributions. So even though you might be contributing $6,500 or $7,000, the same as a traditional IRA, really that contribution is greater because you've already paid taxes on that contribution, where with a traditional IRA, you will have to pay taxes on those contributions down the line. Third, don't forget to take RMDs. It's not a good idea. It really just increases your tax liability, which is the entire opposite of what we want to be doing at this stage. If you miss an RMD, you could face up to 25% excise tax. If you correct it timely, that could be reduced to 10%. However, even 10% is really just, not a great idea. So make sure that you're paying attention to when your required minimum distributions are due for the year. Fourth and finally, if you are an experienced alternative asset investor, or you're looking to really diversify your retirement portfolio with real estate, private equity, promissory notes, consider a self-directed IRA. If you don't have one already, these accounts, you are able to invest your retirement funds in alternative assets, gaining some diversification from the volatility of the public markets. And if you have expertise in one of these fields, you might have an advantage over the competition. You might be able to spot diamonds in the rough better than others out there. And yeah, there's generally less people scrubbing through every single opportunity in the private markets compared to finding a hidden gem in the S&P 500. It's going to be much harder. All in all, these accounts really open up the private markets while giving you the option to reduce your tax liability. Keep in mind, in order to get the full benefit from these accounts, you will have to follow the IRS rules and guidelines, which we have listed on our website. So by maximizing your contributions and staying on top of your account responsibilities, you can benefit from tax advantage growth opportunities and really see those opportunities compound over time. For more tax tips for SDIRA holders, including a closer look at how Roth IRAs can beat out traditional IRAs over time, take a look at our Tax Tips for SDIRA Holders blog post linked in the description.